Hi, thank you everybody for joining us on our Thursday live webinar. It's so good to see so many of you here with us today. And we are featuring Caeli Ridge of Ridge Lending. Welcome, Caeli.
Thank you, Stacy. How are you?
So great to have you. I'm doing well. So we're so excited to talk to everybody today about real estate lending for investors, how to understand loan costs and negotiate better terms, all the things us investors love, right?
I can't wait.
Perfect. So we have a few other upcoming webinars, and the best part about joining is that you get to interact with us, and that includes today too. So always, please feel free to drop your questions in the Q&A box below. We love hearing from you. But then also definitely consider joining some of these upcoming webinars. We're featuring San Antonio next week, new member orientation for how to extract the most value out of real wealth. That's April 22nd. And then a Columbus, Georgia income property showcase will be on April 24th. So stay tuned for those. Oops, so sorry about that. And then we also have some upcoming property tours. This is a great way to be in the local market and meet the team. And then it's also a great way to meet some of us investment counselors. So if you don't have plans this weekend, Leah will be attending the Chattanooga, Tennessee property tour. So a great place to meet her, meet other people, and also see the team in market. We have Jacksonville in St. Augustine. It's a beautiful area, so I highly recommend this. That one is April 22nd, or I'm sorry, 26th. Cleveland in May, and then I will be attending the May 24th San Antonio property tour. So please come meet me as well. I would love to see you all.
Those are always so fun.
Yes, I
Yeah.
agree. Yeah. So just a quick disclaimer, this is an educational webinar. All the strategies mentioned in the presentation might not be appropriate for you. We always recommend that you consult your own accountant, tax advisor, lender, attorney to discuss the specifics of your situation. Past performance is no guarantee of future results. And then we're just going to talk a little bit about me. So I am an established real estate investor. I've been investing for over 5 years, and I got started to replace my income so that I would be able to leave healthcare, which I have successfully done. And I am so grateful to now be an investment counselor here at RealWealth. I recently retired at the end of last year from the military after 21 years of service. And I'm just so excited to be all in on real estate and share the power of real estate investing. We'll go ahead and skip that. And now I'm going to hand it over to you, Caeli. Would you please tell everybody about you?
I would love to. Thank you, Stacy. Hey, gang. Hopefully there's some new people on here, and certainly love having those that are familiar with me and what we do. I'm going to kind of skip through who I am. I'm not going to bore you guys with my resume, except to say you can see here on the slide, I've been doing this for a very, very long time. What's unique about me personally is that I'm a fellow real estate investor. And as a lender, having both of those lenses, I think that there's some value add there that I can share my experiences. I've got plenty of both good and bad that I am able to impart to our clients, that they can take what they want and leave the rest, but at least they've got more information, and that's the point. So let's go on. And am I in charge now, Stace?
Yes, you should be.
Okay. All right. So I think just about me in particular, I've been doing this for a long time. We focus on investors' needs, and I'm an investor, so I'll be able to bring that extra experience to the table. Let's move on though more about the company. So for those of you that are new to Ridge Lending or haven't worked with us or heard of us before, a few things that I would want to share with you, some value adds about us as a company, I think is a few fold. First, I would say we're really known for our education. And I think that's why that Ridge Lending and RealWealth synergize so nicely together, because Kathy and Rich are all about education. They always have been. We go back many, many years, and it really resonated with her. When I first met Kathy, it was Walnut Creek, and I want to say it was the early 2000s, somewhere in that area. And that was her focus. It was really that education piece, and it struck me that that's where we were. And anyway, it was a meeting of the minds. Education, I think, is key. Real estate investing, you guys, maybe you've heard me say this before. The learning curve is tough. There is so much to learn in real estate investing. And that is just in one or two capacities of real estate investing. If you're really going to learn what you need to know about investing in that asset class, you've got fix and flip, you've got buy and hold, you've got short-term rentals and long-term rentals, you've got single family to 100-unit apartment complexes, syndications. There's a lot of modalities going on there. So again, learning curve is pretty intense. I always talk about the learning curve in adding in the leveraging side, the use of other people's money, right? The new language of finance. Without leverage, our rate of return is greatly diminished. I think, and I'm a big believer, that a real estate investor needs to be working with a lender that really understands the differences in finance for investment property loans. It's very, very different. And we'll get into that in some of the other screens. But the education piece is key for us. And we put a lot of time and energy into providing that information. And I personally do a lot of one-on-one with our clients where very strategically and customized, we look at what their qualifications are today. We figure out what their goals are in a year or 10 years. And then we kind of marry all that together and really empower investors to understand how to maximize qualifications, right? We're investors. So things like debt to income ratio and credit scores and assets, they're going to be a very fluid thing as we're buying properties or selling properties or entering into 1031 exchanges. So to understand from an underwriting perspective, how do I keep my debt to income ratio at its best place? How do I keep my credit score at its highest? What are the reserve requirements as I continue to acquire properties? So all of those things come into that education. And I wanted to lead with that because I'm really proud of that part of what we bring to the table. So education would be one. The other thing I want to share with you guys about the company is that we are anything if not a one-size-fits-all lender. We have an extremely diverse menu, I call it, of loan programs. We'll get into some of that as well. But if you don't fit into this buy box of lending or access to funds, I've got 12 others that probably will fit that we can apply or present to you. We're licensed nationwide, so we have a very broad footprint. The only state that we are not lending residentially, we can still do commercial there, but the only state we're not lending residentially is New York. Otherwise, we're going to be everywhere you guys are looking to diversify in. And customer service. That would be the other thing I want to share with you guys. I know it isn't talked about a lot, probably not in this setting is very common, but I'm a big believer of customer service. And I don't know about you guys, I've been talking about this lately. I feel like, and maybe it was pandemic related, I feel like customer service kind of fell to the wayside. That's just been my experience. And that's always been a big part of what we want to bring to the table is accessibility, accountability. It's important to us. So that's who we are in a very, very brief nutshell. I will move on from this. Let's
Shaylee,
get into, yeah.
if you don't mind, I'm so sorry. I actually want to echo your sentiment. I have had so many calls with investors, but also heard this from RealWealth staff members that your one-on-one calls are so educational and so beneficial. But they also feel like you really give that long-term perspective in what's best for the investor and their outcomes. So I just wanted to echo that to everybody that absolutely take her up on this offer for those one-on-one calls. It is a reason why they are our premier lending partner. And I just wanted to commend you for offering that value to our community.
Thank you, Stacy. Thank you. I really appreciate that. Yeah, guys, we're not interested in some one-off commission. We're really about building that relationship. And there will be plenty of times where I'm talking to a new client and I say, you know what, Ridge is not going to be the best fit. We're not going to try and fit a square peg in a round hole just to get some, one-off commission. So yeah, all of that stuff is very, very important to us in building that relationship. Thank you for saying that. Okay. So kind of getting into the nuance or granularly about some of the value adds that Ridge, I think, brings to the table. Why is it important to work with a lender that focuses and understands the non-owner occupied side of lending? Okay. I'm just going to see what's next. Okay, that'll come in a second. So I'll just stay here and I'm going to talk to you guys. Like anything, lenders are not created equal. Okay. As are surgeons or appraisers or, whatever facet you're looking at, there's going to be the really, really great ones and the ones that do okay. And then the ones that are just going through the motions. As it applies to this part of our conversation, here's what I would tell you guys. When you think about the mortgage industry as a whole, okay, and I'll bet you a lot of people on this call are going to relate to this. Most of the transactions that are closed, mortgage transaction are closed, the vast majority of them are going to be for owner-occupied transactions, your primary home. And while Ridge is fully functional, we do all of that as a direct lender, our skill sets are for largely a real estate investor. I cannot tell you how different the mindset is between a lender or an underwriter or a processor or a loan originator or an insurance agent or an appraiser all of the experts in this big orchestra of getting a loan secured, it is night and day. Owner occupied, non-owner occupied, totally different animal. And if you're working with a lender that doesn't understand or doesn't do a lot of the non-owner occupied, you're going to have some brain damage. Let's just say that. So for those that are brand new to real estate investing, maybe you haven't even started yet, or maybe you've purchased one, you probably don't have a ton of experience with this, but I promise you, if you're going to try and work with a local credit union or a lender that just doesn't have that acumen, you're going to have some bumps along the road. Those of you that have been doing this for a while, if you pick up the phone and you're talking to a lender where you quickly realize or learn that you know more than they do, hang up the phone. It's going to be nothing but pain. But let me give you some specifics. So I have some notes over here, you guys. I'm gonna lean on. So a lender that really understands non-owner occupied is going to be able to guide you in ways that say, okay, your reserve requirement right now, especially because, let me back up for a second. So as investors, it's very unlikely that we're just going to have one transaction. We're not going to just purchase one investment property, right? We're going to buy more or sell some, or et cetera, et cetera. So it's going to be an ongoing thing. If you're going to be working with a one-off lender, a Rocket Mortgage, and not to beat up Rocket Mortgage, I'm sure they have value adds, et cetera, but they're not going to be able to guide you to say, okay, Mrs. Smith, you now have 4 finance properties. You're purchasing another one in a month. We need to start talking to you about your reserve requirement, okay? Because it's going to change as you evolve. And that's kind of what I was talking about earlier in that customized education. It's really, really important to have that contact and to be able to pick up the phone and say, hey, Caeli, hey, Ridge, this is what I want to do this year. Can you help me get set up? I would say that that's probably the number one thing in making sure that you guys are working with a lender. And there's not very many of us. I know most of them, by the way. There's probably 3 or 4 others in the country that I'm aware of that know what I know and that do what I do. So you want to be real picky about who you're going to entrust this huge piece of your financial health and security and future needs. You want to be real clear on who that partnership is going to be with. Let me find my notes here about, I think the bigger things too for you guys that you're going to want to be looking at and asking questions of when you're talking to different lenders. Hopefully it's with Ridge, and we'll have all those answers for you, of course. That nationwide footprint is going to be important. Okay. Establishing, unless you're okay to continue to recreate the wheel every time you need to get financing and then submit those vials of blood and DNA samples again and again and again with a new lender every single time. You guys know that's my token joke. Fine. If that's okay with you, then by all means. If you want that relationship, you definitely want to have a lender first and foremost that has that nationwide footprint. Because if you're doing it right, in my opinion, you're going to be diversified. You're not going to want to have all your eggs in one basket. Okay, that would be the first thing. So make sure that that lender has nationwide access to fund your loans for you. The diversity of loan product. Okay, this one's key. I touched on this briefly, and I think there's some other slides that'll get further into it. But if you're just going to go to a credit union, their buy box is going to be this small. Okay, and if you don't fit into it, they're not going to be able to accommodate for somebody that's self-employed or that just became self-employed or that needs a fix and flip loan or that might need a ground-up construction or that doesn't offer more than 2 investment properties per individual, right? All of these different things. So you're going to want diversity of loan product. That's going to be real key. We've already talked about the education. Let's talk about what is top of mind for most people is rates, right? That's invariably within the first 30 to 40 seconds that I get on a call with a new investor. What are your rates? Well, sometimes, you get tired of hearing that, and I might be a little bit flippant and say, well, what do you want them to be? And that's really a true statement, by the way. It's what you want them to be. You guys know you have the control to get whatever interest rate you want. It's going to depend on whether or not you want to pay for that interest rate. And that's kind of the point in this part of the commentary. You really want to have a lender that can shine a light on the math. Okay, if anybody that's on this call has listened to me speak before, I'm constantly berating you with do the math, do the math, do the math. You want to have a lender on your side that if you don't already have the math committed to memory, that they will break it up for you and say, okay, Mr. Jones, if you're looking at 7.5%, that's the rate that somehow psychologically you've decided that you need to have. Okay, well, this is what it's going to cost. However, Mr. Jones, let me give it to you this way. Does the 7.5% at 2 points make more sense? Or does the 7.625 at a half a point, is that going to be more to your advantage? And the math is going to be very, very simple, actually. You're just going to be looking at the payment difference between the rate difference and divide that by the cost. So an easier way to say that is that you do need a lender that knows those pluses and minuses and can educate you in a way that you can look at the deals in a very business friendly manner so that you're making the right decisions. If you don't have that information, or you're working with a loan officer or a lender that either is of scarcity mentality, we're all about abundance here, or just doesn't have the information, you will be at a disadvantage. Okay.
Caeli, do you mind sharing actually how some lenders are able to offer those lower rates versus others?
Sure. I will tell you. So I know that so what I've seen recently in that space, Stacy, is where builders are buying the market. And you guys, you're paying, I promise you this, okay? You're paying for it one way or another. Whether you see it visually or not, they are not doing it for free. So those builder, like I think that even in the last year or two, 4% rates, 5% rates, these really, really low rates, it's built into their margins. Maybe they took a little bit of a haircut, but it is already built in. They have their build, they have their construction costs, et cetera. But the 20,000 or the 15,000 or whatever, I saw a few of the final closing disclosures on those deals. And there are these huge credits that are being used to buy down that rate. Now, if they can afford to do that, I have no problem with it all day long. I'm not going to even be close in competing in that way. If you can get an investment property where the builder is going to give you a $20,000 credit to buy down the interest rate all day long, take it. I would. So
Yeah.
that answers your question, right, Stace?
Yes, thank you.
Yeah. I talked about customer service. That's a big deal for me. Nationwide lending, experience in dealing with a lender that understands and caters to investors. I already talked about that. So I guess you guys get the point, right? You want to be working with a lender that understands how to, this is one of my favorite sayings, understands how to navigate the battleship in a creek. And that's what lending feels like sometimes. Anybody that's gotten a loan in the last 10 years, they know that dumb joke that I have of vials of blood and DNA samples, they know what that means because they've been there, done that. You really need to have someone that has their finger on the pulse of non-owner occupied loans, products, and all the things that I mentioned here. So I think that sets the stage pretty well. Why don't I move on to the next? So I think that what will be really valuable for you guys that are here today, I think that this might have been a hook for today's webinar, is let's talk about closing costs and loan estimates, okay? I'm going to share my screen and so that I can just pull up my version. Let's see how smart I am here, you guys. Hold on. Haha, I did it. Okay.
I believe in you.
Haha.
Yes.
Okay, so this is an LE, a loan estimate, an initial loan estimate. Okay, there's got a lot of data points on here, and I want to stop and just take a quick second. So I've been doing this for what feels like a few hundred years. This particular document used to be called a GFE. Anybody that's been around long enough will remember that good faith estimate. And a good faith estimate used to be one page. Okay. Nice and simple, line itemized, everything was compartmentalized and you could see it nicely. I thought it was a good document. Well, the powers that be, with some oversight and regulation, and I'm not totally opposed to oversight and regulation. There's certainly a place and time for that. But a lot of times the people that are making those changes, they really don't have the right basis of understanding and knowledge. My problem with this document is it's now a 3-page document that, by the way, doesn't even require a signature. Did you guys know that? The LE doesn't even require a signature, whereas the good faith estimate, the GFE, used to. I feel like this has done the opposite in many ways to what its intent was. This was meant to provide clarity to the consumer. And in my opinion, when I looked at the old GFE versus this thing, I don't think that's what it's done. I think that it's kind of convoluted things in a way that isn't crystal clear or seamless to the consumer. Anyway, okay, so let's just kind of go through some of these data points here. You're going to have the lender name up here, and you're going to have your name and the property address. There's going to be a value here. I mean, these are all just kind of boilerplate things, you guys. This first page here is just pretty static, right? I mean, I probably don't need to go through line by line, I'm guessing. You'll know down in this area if you're impounding your tax and your insurance, right? If for those that like to pay them separately, if you want to pay your taxes and insurance on your own, you can look right here. And if it doesn't say no, then you need to get in touch with your lender and say, hey, I'm waiving those. I don't want those included in my mortgage payment. One other thing that you want to look at if you're going to be comparing different quotes is right here, rate lock. Okay. Actually, this brings up a pretty good point. And Stacy, hey, just check me on time if I start running over. Okay.
Yeah.
So, and I am not here to disparage my competition. Okay. That's not what I'm about. That's not what I'm intending to do. But I do want to make you guys aware that a lot of times the impression is what people are left with, or the perception. When they get a rate quote, because the lender that may be quoting him knows that it is not a locked rate, I don't want to say they can put anything on here, but they can definitely lowball to get interest. I can't tell you how many times somebody has come and said, hey, this is my scenario. Can you get me a quote? Of course, here it is. And then they bring it back and there's another quote that maybe beat me by a half a point or a few $1,000 or whatever it is. Where what am I going to say? Of course, I understand. Not only to have them come back and say, I'm at the closing table and the rate is a point higher than yours and yada, yada, right? The conversation wasn't finished. So just be mindful of that. If the rate is not locked, you just need to be watching the market or asking somebody that knows where that right rate might be going. If when you go to lock that interest rate, it's far different in rate or points than what you were originally told. Okay. Okay, let's go down in here. And if there's questions that you see, Stacy, where people have certain parts of this where they really want to dig into, I'm happy to go. I don't look at these forms as often anymore, but I think what would be helpful to everybody is kind of focusing on this second page where the costs kind of are more broken down. Okay.
I agree.
Okay. So here are your closing cost details, gang, and you can see here that it's organized in chunks, A, B, C, D, et cetera, right? It's pretty self-explanatory here. You've got origination charges, you've got what they say, services that you can shop for, though most of you don't do that. How many of you know appraisers or AMCs in which you're going to order the appraisal from? So I don't know. Anyway. And then you've got your more services you can shop for, title and escrow. Again, on a refinance, more often than not, you guys are leaving that to the lender to use the relationships that they have. If it's a purchase transaction, it's the seller typically that's going to drive escrow, aka the agent, the seller's agent typically is who's driving what company you go to. Now, these are regulated. Okay, these charges are what they are. They're the typical third-party fees. They're estimated on these loan estimates. That's why they're called estimates, you guys. So be prepared for these are not hard numbers. And I will tell you something else. As the lender, at least the way I do it, I never want to be in a situation where I have overpromised and underdelivered. So I'll give you an example. Let's focus on these right here. So in the initial LE, loan estimate, we're always going to overinflate some of these charges. As the lender, if I come in low on an appraisal fee, let's say that I put $500 here and the appraisal fee comes in at $700, because I disclose it as the lender, I've got to cure that cost. So as we're just getting started with the initial LE, I don't know for sure how that's going to break down. So we kind of hyperinflate some of this stuff until we know exactly what it's going to look like. I'll give you an example. Let's say the appraisal is really only $700, okay? And we were given the green light to go ahead and get the appraisal ordered, and the appraiser went out there and couldn't gain access to the property. So the appraiser is going to say, okay, I'm going to charge you a $200 trip fee for that snafu, right? Without totally outside of our control. If there's an extra $200 charge for something like that and we didn't disclose for it because we didn't know to disclose for it, right? We wouldn't have that on there. So that's one of the reasons that we kind of hyperinflate that. Similarly with this desk review, 99% of the time it does not apply. So those are some of the questions that you're going to want to be having, or I actually have with my clients when these go out, is just to kind of give them that heads up. 99% of the time, this won't be present. 99% of the time, this is going to be $600 or $700, depending on the state and the property type. This can kind of vary pretty widely. If it's a fourplex in Florida, for example, I mean, this could be $1,500, et cetera, et cetera. Similarly here, and so on. Now, these down here,
Caeli,
yes.
I'm so sorry. Is it
No.
fair to say then that the B and C category are the only fees that can be negotiated, or are there lender fees that can also be negotiated?
So I'm sure that there are lenders that will negotiate their fees. We won't do that, and I'll explain why in a second. And I doubt, honestly, you guys, that you could probably get a, I don't know what your negotiation skills are, but if you could get a title company to negotiate lower fees, some of these I think are mandated. I like title insurance. They have very specific formulas that they use, like per thousand of loan amount that the title insurance per state is regulated by. So I don't think you can get away with that. But things like a notary fee, you could probably negotiate with the notary, maybe. Things like the closing fee for escrow, they might be willing to negotiate. I've not seen it happen, but to your question, sure, you could try. You could. I mean, no,
Perfect.
I was raised no ask them, no get them. So it's not going to hurt to pose the question anyway, I guess. Um, Okay, but similarly, as I set up here, there may be some inflation in these numbers by a few $100. Nothing big. It's not going to be huge, but we're going to kind of keep that conservative to make sure that we don't have any lender cures that we have to come out of pocket with later. And then here we go into the government and taxes. So recording, right? Transfer taxes. Transfer tax would be um, Florida is a good example. There's something in certain counties called a state stamp tax that would be applicable in parts of Florida that you would be looking at as a transfer. And it doesn't matter if it's going from your name to your name, right? A lot of times people will assume that a transfer tax is when you've got an LLC and you got to pull it into your name and then back in, right? That quit claim deed thing. It wouldn't matter in that case. So make sure that you've kind of crossed that T. Pennsylvania is another one that has some pretty high transfer taxes in certain counties. So if you're doing a refinance, for example, you're going to want to know that in advance. If you weren't prepared for it, it could be thousands of dollars. So double check on that, or just ask me, and we can get you some answers. Here are our prepaids. All right, taxes and insurance. It doesn't look like we have the data points in here yet, but if insurance, for example, guys, you have to have 12 months of insurance no matter what, whether it's a purchase or refinance. We want to see that the homeowner's insurance has been paid for a full 12 months. And then down here, we have some additional months in reserve that we're going to collect. So just depending on when the insurance is due or when you last paid it. Similarly with the property taxes, if it's a purchase, when from the date that you take possession of that property up until the end of that particular tax year, changes from county to county in many cases. So those are going to be defined by those details. But let me say something about taxes and insurance. Prepaids, escrows, impounds, all of those mean the same thing in many cases. That's why the lending can be so confusing, is that barrier for entry of language, having 5 different ways to articulate the same thing. The taxes and insurance, though, in collection for a mortgage are more of an asset than they are of a cost. And here's why, because you're going to pay those regardless, right? The insurance, you got to keep the property insured, especially if you're going to have a loan on it. That's a foregone conclusion. And then taxes, okay, death and taxes, right? So those are going to have to be paid. When you're getting a mortgage, all right, we got to show that year's worth of insurance. And then down here, as I mentioned, there's a few months of reserves. The reserves can be anywhere from 1 to 3 months on an investment property. So these just kind of go all the way out, 3 months worth of reserves. Now, those are collected up front, but those are set aside. So if you ever go to sell or refinance that loan, sell that property or refinance that loan, those monies that have been sitting in reserve and escrow will be refunded to you within 30 days of the refinance or the sale. So think about it. I understand that it is an actual cost that you're bringing, but really a lot of the times it's going to be an asset that's kind of left there, assuming you don't go into default. And the reason that they do collect the extra months is in the event of default. They want to make sure that they have a few extra months to have to go through the foreclosure process, get the property back, maybe get it ready to resell, etc. That's the reason for the reserve, especially on an investment property. And then you kind of see the totals, right? E plus F plus G plus H is right here. Then you've got your total down here, and then some of the pluses and minuses. The math should make sense. Let's see, Stace, I think there was something else about this that we had chatted about that you wanted to ask, I think, right?
No, I asked the only question, the most pertinent, or I guess
Okay.
if you want to highlight anywhere that they might hide fee.
Where lenders might hide fees.
Mhm.
Okay. I think that overall, you guys, the fees are going to be, if there's hidden fees, they're going to be as a function of an interest rate or a miscalculation of a quote. So let's just say, for example, okay, this is what I was talking about earlier with that lock thing, the interest rate lock. Um, they quoted you want a 20% down purchase. Okay. Well, they quoted you 75%. Okay. When you get all of your stuff in and you're ready to go and it's time to lock, it comes back so much higher than what the expectation was, both in rates and points. That's where I would say, if, because it's got to be pretty transparent here. If they're going to hide something, it's probably in how they were structuring it on the front end that may not have been visible to you to start with. And then when it actually comes time for their feet to be held to the fire and the terms change, perhaps because they were quoting something different than what you were expecting to get at lock. Otherwise, you're going to see these, once these numbers are out there, these are going to be the numbers. If there is a cost to cure, COC is what we call it, there's a whole new set of disclosures that go out, and we want to try to avoid that. So you should know what's going on here. Do you have examples or anything, Stace, that happened that maybe I can speak to, that maybe somebody that,
Yeah, you
yeah.
touched on it. The first loan that I closed, they forgot to lock it. They admitted their mistake, but then they tucked the fees into a different place to cover the additional cost of
The
the rate lock at
difference?
a later time. But I do have a follow-up question based on that. When do you recommend that investors lock the rate, particularly if they may not have the awareness of watching the market like
Right.
some of us crazy people do? How do you recommend they determine the best time to lock that rate?
Okay, so this may be a little layered. Under normal circumstances, I would say we don't like to lock in an interest rate until after we have an appraisal. Okay, an appraisal by definition, you guys, is an opinion of value. So while, more often than not, they come in just as they're supposed to, but if there's an issue with the appraisal, whether it be a low value or something else that has to be attended to, that can derail turn time. So a lock in general is probably good for 30 days. Now, you guys have some play in there too. Most lenders aren't going to go into this kind of detail because there's already so much detail that we have to get out to you. But an interest rate lock typically can be locked for 15 days, 30 days, 45 days, 60 days, and even up to 90 days. Okay. The longer the lock period, the higher the rate and or points. The shorter the lock period, the lower the rate and or points. So ideally, right, if you can get a 15-day lock, you probably have a little bit of improvement in, probably not the rate, but the points maybe. More often than not, I'd say 95% of the time, we're locking on a 30-day lock. So having that appraisal in first before that lock happens ensures that we're not going to exceed that lock period, because if you blow your lock, if the lock duration expires, then you're starting to look at additional cost for extension, rate lock extensions, which for us, I think it's pretty across the board. I could be wrong about that, but a per diem every day for rate lock extension. So if it expired today and we still have 5 days before we're ready to close, is equal to 0.02% of the loan amount. So if it was 100 grand, it would be $20 a day, 0.02% of the loan amount for the number of days that you'd have to extend the lock. So for that reason, we really ideally, not always, but ideally we like to lock once the appraisal's back in, because that is that one piece that can kind of derail or force us out of everybody's control to need more time. Okay. Now, that's not always appropriate, right? We're in a weird time. Pandemic to now, let's say starting in, what was it, May of 22, when rates, March of 22, when rates started to creep up, right?
Skyrocket,
When
yeah.
they're really low, whatever, it's a free for all. But when they start going up, and they've been from then to now, they've just really there have been certain periods that are more volatile than not. I think right now is on the high end of volatility. Uncertainty does not bode well for interest rates, I'll tell you guys. And there's been a ton of uncertainty lately. So interest rates, if anybody that's been watching them, they've been all over the place. And they're doing weird things that aren't typical when you're trying to track. If you use the 10-year treasury to kind of track where interest rates are going to go, you were wrong the last week or so. They're just doing odd things. So the 30-day lock, let me get back on track. I went down a rabbit hole. So where did I leave off, you guys? 30-day, when is it appropriate? Oh, so in an environment like this, so normally I like to have that appraisal back in. Okay. When we're in this kind of volatile environment, more often than not, okay, I'm going to tell my clients, let's not hedge. I don't want it's Vegas odds. It feels like Vegas odds. I don't want to play that market. I don't want to play the float game. Very dependent on the loan size. Okay. If it's 500,000 and above, maybe you do play a little bit of the game and you do try to hedge and you try to get real specific on what day the market is going to be best to do that interest rate lock, because that higher loan amount is affected in the payment much more by an eighth or a quarter point than would be that $150,000 loan size. In which case, my commentary to people is the means does not justify the end. Okay. I would lock today at the 7.5% versus floating and hoping I get a 7.2 or 7.375% that might save me $8 a month. I'm not going to do that because the risk of it going the other way is equally as prevalent. So I think that probably answers the question. Right now, I think that locking early versus floating and trying to play that market game, that float game, is usually not going to be to your advantage, in my opinion.
Wonderful. Thank you.
Yeah. Sorry. Okay. So any questions in the chat from the listeners here today about any of the LE stuff?
Yeah, we had one. Is there a fee from title for transferring a title to an LLC?
Sometimes, yeah, I would say so. Let's say for asset protection, you closed a Fannie Freddie loan or whatever it was, and the loan and title closed in your individual name, I'm guessing is the scenario. And then right after closing, you want to put it into your LLC for that anonymity, that asset protection. I would say, yeah, a lot of times the escrow company is probably going to charge you something. Maybe it's $50, maybe it's $100, well worth the protection. It shouldn't be much more than that, though.
Perfect. And then is there any difference in the cost or tax of refinancing a residential loan using a DSCR over a regular loan to close with the title and an LLC? I think
No.
they're at, okay.
Not for title. So I mean, so this gets into something. So if it's just the third party fees, no, there's not going to be any difference between a Fannie Freddie or a DSCR, for example. Now, if it were an adjustable rate mortgage, there may be some nuance or just pretty insignificant additional charges because there are adjustable rate mortgage riders that have to be recorded. So it might be another 50, $100, but it'll be inconsequential. Now, that's third party costs. Are there different costs between a Fannie Freddie and a DSCR in general? Maybe. And they could be significant. It really depends on the deal and something called LLPAs. I've talked about that a lot with RealWealth investors. Loan level price adjustment is a positive number or a negative number, you guys, that associates with the loan characteristics. And the loan characteristics are going to be things like, I won't go too far down the rabbit hole, I swear, Stacy. The loan characteristic differences, they're going to be loan to value, loan size, property type, occupancy. The difference in an LLPA for where you live, an owner occupied and a non-owner occupied, is a big difference. And this is all about secondary market mortgage-backed securities and risk and what they want, what secondary investors, what they want. The non-owner occupied is going to be a higher, riskier loan. A debt service ratio loan is higher, riskier than a Fannie Freddie loan for obvious reasons, right? We're not providing any income documentation. We're just resting on the laurels of the investment property's income. Credit score is another LLPA. Is it a purchase? Is it a refinance? Is it a cash out refi? Is it a rate and term refi? All of these different variables or characteristics of the transaction will dictate the interest rate and the points associated with it. So to go back to the question, is there cost difference between a Fannie Freddie and a DSCR? Aside from those third-party charges, yes, maybe, and they could be significant depending on the deal. I know that's not an exact answer, but hopefully you get the point.
Yes. And even more reason for people to reach out to you so they can discuss their specific situation.
Right. It's all relative to the deal and the individual and their qualification and their goals. Yeah, absolutely. Okay, so I'm just going to move on then. Let's just go into, so this is kind of a fun slide. This came from RealWealth, and I'm so happy that they that they made this. So now I get free reign to say what I want, right? No, I'm kidding.
Yes.
Okay,
Tell us everything.
I got some more notes. So first up, so here's some things that your lender should be telling you. Okay. And I also want to say that these are things that your lender wishes that you knew that they may not tell you, or kind of going back to my original point about working with a lender that isn't investor savvy, they may not know to tell you. Okay. And it could really create massive disruption within the loan process. And I have seen thousands of dollars of earnest money being forfeited, appraisal costs being forfeited. So the first few are kind of relevant to that. So some of the closing killers, okay? Don't change jobs without talking to your lender first. It may be fine, but have that conversation before you ring that bell. Because if you went from being a waitress to now being a hairdresser, you're going to probably have a problem if you were trying to qualify conventionally. Okay, if you didn't tell anybody. So don't change jobs without having that conversation. If you're simply just going from this job to this job and the pay is the same or better and it's the same line of work, it'll be fine. But maybe you're taking a pay cut because you see some future in advancement. That might be okay too if your DTI can support it, as long as it's the same line of work. So those conversations just need to be had. Do not change your job until you've had a conversation with your lender if you're in the middle of closing that transaction. Any major purchases or really just any new liabilities. So at the very end of a loan transaction, the lender is going to do quality control, okay, without going into the acronyms and the mortgage speak. At the end, we're going to pull sort of a supplement report, credit report. It doesn't ding. It's not a new inquiry or anything, but it's going to tell us if there have been other inquiries to your particular Social Security that says, okay, Chase pulled Mrs. Smith's credit. We're going to come back and say, Janet, what was that for? Did you incur more debt? Did you get a car loan or a business loan or whatever that you're now personally guaranteed to? And if the answer is yes, guess what? I have to include that now in the liability column of the debt to income ratio calculation. They may have played themselves out of qualifying. So anything that's going to incur additional liability that used your credit, your Social Security number to pull credit for, make sure that you're having that conversation before you do it, and that we can layer in that potential new payment and make sure DTI is solid. It's not gonna throw you off. Let's see, what's another good one? If you're traveling, and that happens, okay, especially this time of year as we're closing in on summer. If you're going to be traveling during the loan process and or before we're ready to close the docs, or maybe the loan, everything got delayed for whatever reason, and your travel plans happen to fall after the originally expected close date, make sure you have that conversation, okay? It's unless you're going abroad, and even when you're going abroad, we have mechanisms that we can help kind of figure things out. We can figure out like a specific power of attorney. We can put that together, help you do that. We can find an embassy maybe on where you're going to be out of the country. But if you're in state, if you're in the contiguous 50 states, we can always, the mobile notary, that's almost certainly, we're investors, okay? We're very unlikely to be going to the escrow office to sign our loan documents the way that we would for our primary residence. It's almost always going to be that mobile notary. They're available at 10, 11 o'clock at night at Starbucks if you want. So as long as we know, it's really each one of these things that I brought up to now, it's all about communication. Just let us know what's happening so that we can help you prepare and navigate that battleship in a creek that I like to reference. Is it worth buying down points? Maybe. We talked about that briefly in one of the other slides. Do the math. It's really not that complicated. The math is not that complicated, and it'll be what it'll be. Okay. There's going to be some questions to be asked. How long do you think you're going to keep this loan? Is there a prepayment penalty on this loan that we need to be looking at to say, yeah, let's go ahead. You're going to be locked into this for 3 years anyway on a debt service coverage ratio loan. It does make sense to pay an extra half a point in a discount point to get a lower interest rate. Yeah. So those are some of the things that I would love it as you guys are gaining more traction. If you don't know this already, ask those questions. How lending affects DTI. I kind of talked about that. Here's one more. I'll add one more to this, and then I think I can open up for whatever questions may come of any of this. A home inspection. This happens more than I wish that it would. So, and this is a little bit of tough love, okay? There's a lot that goes on in the background of getting a loan secured for our clients. A lot. You guys, I mean, when you hear someone talking about finance, you probably, a lot of you are like, deer in the headlights. It's too much. It's not my language. It's not my speak. I promise you, multiply that times infinity. And that's what's going on in the background to get this loan from inception to the closing table. So it's a lot of manpower and a lot of resources that go into it. The inspection part. So if you're not getting inspections on your investment property, then I would ask you why. You should be, in my opinion. But get them up front, okay? And tell your loan officer who you're working with that I am waiting on the inspection. Pause my application, right? We can take you up to a certain point. Get your application in there, have your credit pulled, get the preliminary pieces put together, but have everybody just kind of pause on at that point. Because if we're 2 or 3 weeks down the rabbit hole of getting this loan closed for you, and then you bring back an inspection that says, oh, I don't want this property anymore, the roof is trash, or whatever it may be, that sucks. So I would say for your sake, and you probably already put money into an appraisal at that point, probably for your sake and your lender's sake, make sure that your inspections and that property is ready to go. Now, things can come up, certainly, and we wouldn't begrudge anybody for that happening. But in terms of timing, I would just say be respectful of what goes into these and what the lender's efforts are, so that, you know, when we have a deal, we're ready to go. Something happens, it happens. It's just the way the cookie crumbles. But that would be one good example of something I wish was said more often to real estate investors that probably isn't. Okay. I'm not talking to hear myself talk, am I?
No,
Okay.
but this is the part I'm most excited to talk to you about.
Okay.
Do you mind touching on conflicting interests with a CPA versus a lender, and how it affects your DTI and may prevent you from being able to use all 10 of your conventional
Yeah.
loans?
So I think what you're referring to, Stacy, is debt to income ratio, right?
Correct. Yep.
Okay.
And preventing you from getting there before you max out the 10.
Right. So 10 golden tickets, guys, right? Highest leverage, lowest interest rate. That's why we call them the golden tickets. And I am fairly confident I am the one that coined that. I've been saying it for 25 years. And I don't remember anyone saying it before me. So I'm taking credit for that. So the golden tickets per qualified individual, Fannie Freddie rules say you can have 10 of these. Now, very important distinction. This has nothing to do with your primary residence. Okay. You could have 100 finance properties and still get a Fannie Freddie load on your primary residence. People get this wrong. Now, your primary residence, if it's got a mortgage on it, will count in the number of finance properties you have. But for those that are renting right now or living rent free, you could go out if you qualify and get 10 Fannie Freddie loans, all for conventional type mortgages. And then your 11th purchase could be your primary residence, and that's perfectly fine, and still maintain Fannie Freddie products. Okay. Okay, back to DTI. So debt to income ratio is really where the bigger part of this falls. Now, there's going to be some differences in requirements for credit score and reserves, as well as you continue to acquire properties that, if we have time, I'll layer in secondarily. But rental income versus the monthly mortgage payments that we have as liabilities, as debt. There's 2 ways in underwriting that we are going to calculate rental income from investment properties. The first way is called the acquisition year. I'm going to quickly give you the formula and not give you any of the nuance and move on to what Stacy's point was, which is the second way to calculate income, Schedule E. Okay. Acquisition year is 75% of the gross rents minus the PITI. Boom, done. There's more to it, but I'm going to leave that and really focus on the Schedule E. Once the property falls on a Schedule E, so from the date that the prior year's tax return is filed, okay, whenever that is in say 2025, anything that was purchased in 2024, the minute that you file 2024's return in this year, the Schedule E formula applies. And as simple as 75% of the gross rents minus the PITI is, times 1,000,000 is how complicated the Schedule E is. I'm not going to try and articulate for you verbally. It's just going to confuse us all. But there's income that you claim and all the expenses, and there's add backs like interest and insurance and taxes. Depreciation is also an add back. So there's a lot of moving parts in there. The point is, as investors, one of the beautiful things about real estate as an asset class is that we have this ability to pay less in taxes, right? And the more aggressive that we are with the deductions on our Schedule E, and for those of us that are claiming that real estate exemption, right, real estate professional exemption, who can really take advantage of that stuff, You have to get to a certain point. That's not my conversation here. But the more aggressive you're going to be on that Schedule E with those deductions, the more it could potentially impact your debt to income ratio and ability to qualify within those golden tickets. CPAs, their job, if you've got the right one, is going to be to maximize those deductions and help you save in taxes. You're paying less in taxes if you've got the right CPA doing what they're supposed to do. But the CPA doesn't know underwriting guidelines. Why would they? They shouldn't, right? That's not their gig. Now, there's some that know enough to know what to do, but it's really, really important that you have those two features of your investment team, of your structure, that they're talking to each other, okay? So we work with our clients' CPAs very regularly to give them a look under the hood. There's pre-formulated worksheets that we use in underwriting guidelines that are specific to the Schedule E. I'll show CPAs, look, here's the pluses and minuses. This is what I can do. Now take this and make sure that that balancing act is we're maximizing the deductions for the client without precluding their qualification over here in an underwriting department, right? So there is some push and pull, but as long as the two entities are talking, you should be dialed.
Yeah, that's amazing.
Yeah. So in that way, I think I do have an extra few seconds for the credit and the assets. And some of this may be old hat to some of you, but I think it bears repeating anyway. So debt to income ratio, there's a lot more about the DTI part. We don't have time for that now, but I can quickly kind of give you some of the other things about maximizing those golden tickets. So we've got our 10 golden tickets, right? As it relates to credit, in 1 through 6 of the 10, there's no hard and fast for credit score. We've got clients that can get approved with a 650 credit score if they have compensating factors, low debt to income ratio or strong assets, perfectly fine. So it's kind of vague in the credit score requirement in 1 through 6. When you get into 7 through 10 of the 10 golden tickets, they raise the qualification bar, and now you must maintain a minimum middle credit score of 720 or greater. Okay? You will not get a conventional loan if you have a 719 in any of the 6th, 7th, 8th, 9th, or 10th buckets. Now we have some, and part of that education that I keep hammering on, we have optimization where I will teach you how to keep even 800 credit scores, by the way, can take that dip. Okay, it's possible. It's called rapid acquisition. So if you guys want that education, we'll get into that. Now let me tell about the reserves. So the reserve requirement can be liquid or non-liquid, and similar to credit, the requirement changes based on how many finance properties you have. The easy rule of thumb is you're going to need to show 2, 4, or 6% of the unpaid principal balance of the rental properties, depending on which bucket you fall in. Okay. And we have a cheat sheet for this too. I think it might be on our website, or just email info@bridgelenninggroup.com and say, hey, where's that reserve, multiple property reserve cheat sheet? So if you have 1 to 4 finance properties, I want to see 2% of the unpaid principal balance of the rental properties as reserve. If you have 4 to 5, that goes from 2% to 4% of the unpaid principal balance of the rental properties in reserve. And then if you go from the 6 through 10, I want to see it jumps to 6%. Okay, so you take that calculation and then you add 6 months worth of PITI, principal, interest, tax, and insurance on the subject property. So I'm going to quickly give you an example, and then I think this is where I end, and we can have any questions that are left. So here's the example. You are purchasing your 9th rental, which is falling in spot number 10 because your primary residence is number 1. Okay. Number 10, number 1 is your primary. Number 10 is a subject property that you are purchasing. So it's your 9th rental. Properties 2 through 8 have unpaid principal balances of $100,000 each, just for the easy math. So I have $800,000 of unpaid principal balance times 6%, because you're in that last bucket, is 48,000, right? 48,000. And then our subject property, number 10, finance property number 10, or rental property number 9, has a principal, interest, taxes, and insurance of $1,000 a month. I need 6 months PITI of the subject, so there's $6,000 plus 48,000 from over here would be $54,000 that individual in that scenario would need to show in reserve. And those reserves, like I said a second ago, can be liquid checking savings, or they can be retirement accounts, 401k, whole life insurance policy, etc. And that's how you maximize your 10 golden tickets.
I love it. Perfect. Well, let's go to the next slide. We'll let you highlight some of your unique loan
Okay.
products, and then we'll dive in. We have some really good questions in
Okay.
here. So we'll hop into that next.
Okay. Guys, I said at the start of the hour, we're not a one size fits all. We have so many products. I'll rattle through and then I think I'll end on what's on the screen here. So we've got the Fannie Freddie, the golden tickets. We've got what's called non-QM. Inside non-QM, you've got DSCR, debt service coverage ratio. You have bank statement type loans to prove income, asset depletion loans to prove income. We have ground up construction. We have bridge loans for those that are doing shorter term fix and flip or fix and hold. We have commercial for residential, commercial for commercial. And then finally, I will end on our all-in-one, which most of you, if you've been watching RealWealth for any period of time, you've heard me talk about it with Leah and some of the other group. This is a cool loan. In fact, it's my absolute favorite loan product. For those that are good candidates for this loan, I do not believe that there is another to rival it. This is a first lien HELOC that will allow certain individuals to massively reduce or diminish the amount of interest that they'll pay over time while allowing them to have incredible flexibility and this line of credit for 30 years that they can do what they want with. And for real estate investors, when I initially start talking to people about the all-in-one, and the first step is to see, are they good candidates, which will tell us if they're able to save interest with this loan product or not, versus say a 30-year fixed. Once we've established that, then I really get to open up and talk about the real value adds of the all-in-one for investors. Having this line of credit, you guys, at your fingertips for 30 years to pay down and draw up and buy this investment property, pay cash for it, maybe do a cash out refi. You've got your down payment for the next one or whatever. You've become your own bank is how I like to articulate it. Right? With the all-in-one, you've become your own bank. You're not pre-qualifying every time you want to harvest equity out of that property. You're not paying closing costs every time you want to do that. And there's a lot more that I could go on and on about. I could not be a bigger fan. It doesn't work for everybody, but that is my absolute favorite. And I will end on that and whatever questions you guys have for me.
Perfect. So the first one is Amy is asking and I believe she's referring to the conventional loans, is the count on the number of loans or the number of properties?
Thank you, Amy. It's the count of loans. And let me quantify that. So it's not the number of properties, okay? It's not the number of doors. So a duplex doesn't count as two. It's any residential property, single family up to 4 unit, that has a mortgage on it that is in your name or personally guaranteed by you. Fannie Freddie rules say that even if you have a commercial loan, let's say you got a loan that was set to your entity, you got it in your LLC name. A lot of times investors think, well, that one's not going to count. It will count because you signed a personal guarantee. If it's a residential property, it's highly unlikely that you got a commercial loan that was what we call non-recourse, no personal guarantee. So it's, to answer the question, any residential property that has a loan on it that is in your individual name or you signed a personal guarantee for, that will count within the 10 limit.
Perfect. And then I think it was Karen asked, where do you verify the amount that you've used? Do you just recommend they look at their closing documents
The amount that they've used
of the conventional loans?
Oh, how do we determine if they've got 1 or 9? So
Mm-hmm.
the documentation that we're going to collect, it'll be from a few different places actually. So if you have private loans, let's say that aren't reporting to your credit maybe, or maybe you got a commercial loan that signed by you, personally guaranteed by you, but isn't reporting on your credit, we'll find it in a couple of ways. So your tax return, and this is for Fannie Freddie, right? If you want Fannie Freddie loans, we're going to collect all of those documents. So your tax return is going to show me if you've claimed interest. Okay, that would be the first place. And if you can't claimed interest, I'm going to say, okay, where's the mortgage statement for this? And we'll start digging there. If you didn't claim interest or it's not there, then the insurance statement will have a mortgagee clause on it for whoever is entitled if, as the lender of that property. So there are going to be a few places that we'll be able to go to identify that says, yeah, there's more going on here. And then we start digging. I'll tell you guys, underwriters don't miss a trick. Okay, they're highly skilled in almost warfare, I feel like sometimes, to find every little detail about how this person is going to be able to repay within the confines of Fannie Freddie, which, by the way, real quickly, there's something called an overlay. If you guys have gone to a big boy bank or a smaller credit union, et cetera, and they said you didn't qualify, I would encourage you to give us a shot at that, because they may not be allowing for depreciation add back, right? That might be an overlay. Fannie Freddie's purest form of guidelines, we're going to follow directly Fannie Freddie guidelines. We are not going to impose layers of overlay for risk purposes. So if you've been turned down before and you kind of questioned it, I would have you check with us too, because chances are they're just not giving you the credits that you may be entitled to.
Perfect. For your DSCR loans, what's required to establish projected income? For example, if the project includes rehabbing to accommodate co-living, or like a per night month rent that would be higher than a long-term rental, and there's no established record for that level of income generation.
Well, AirDNA, usually, if it's a purchase, first of all, it'd have to be a purchase. If it's a refinance and there's no established, there's nothing that we can get, no tax return yet that shows that you've collected this kind of income, nothing, you're gonna have a hard time. There's probably something. I would call me and we can talk through it. But on a refinance basis, AirDNA is someplace that we'd look, probably. And you're only going to be allowed something like that if we can prove that it just went under massive renovation. Because normally on a refinance for a debt service coverage ratio, we're going to want to see a lease, or some other form of detailed history of income, like short-term or mid-term rental. So I think that there's probably more conversation there. I would tap me offline.
Perfect. Are there any types of typical fees for a cash out refi loan? If somebody has several rentals, is there any way to combine, like, do you do a discount on fees or anything of that nature?
We don't. And it's such a good question. And I don't love the question only because I seem so inflexible. So we do not have like a like bulk transaction discount. And the reason for it, I mentioned it earlier, our margins, we don't get fat off these loans. We do a lot of volume. We're good at what we do, but there isn't a lot of meat on the bone. So discounting, given all the work that goes into like a multi-pack, I mean, and that's very common for us. So we may be doing, right now I'm doing 10 refinances for one individual, when in my mind, when like early on, I would think, it's going to be easy. I've got just this 10 and we just duplicate. It actually ends up becoming exponentially more work to connect all of those moving parts and dots. So unfortunately, the answer is no, we do not have a multiple transaction discount, but are there the fees, can you combine them? So there would be a scenario where you could look at a cross collateralization loan, like a commercial type loan where we bundle those 5 properties or whatever into one commercial blanket loan. However, points, for example, are going to be calculated on the loan size. So now that they're all added together, it ends up being 6 of 1. I'm not sure that there's much savings, and the terms aren't going to be as favorable doing it that way. I would say that's another one off book that we can kind of look at your REO, real estate owned, and kind of figure out where you might be most it might be most advantageous, and where we can see to save some money. But our fees, no, we don't discount those. Thank you for the question though.
Yeah. Sophia asked, what are your thoughts on interest-only loans?
Oh, I love them all day long. Absolutely love an interest-only loan. Now, how much time do we have? I know we're over. Is this okay?
Yeah, I think so.
Okay. So I am a huge fan of adjustable rate mortgages in the right market. We are on an inverted yield right now, which means that 30-year fixed mortgage rates are better than a traditional 5-year ARM. So an ARM is not really an option. Under normal circumstances, when the ARM is a half or a full percentage point lower than a fixed, I love an adjustable rate mortgage, especially for real estate investors. So, and this kind of plays into the interest-only question and answer too. The average shelf life of a investment property mortgage is about 5 years. Okay, traditionally, look it up. Statistically speaking, it's about 5 years, about 7 years for owner occupied. Now take a 30-year fixed mortgage. Anybody that has looked at an amortization table or their closing documents before knows that the first 10 years of that loan, maybe even a little bit longer, this much of your payment is going to principal, right? Nothing. And because you're going to be probably refinancing it to either reduce an interest rate and increase cash flow, or maybe you're going to harvest equity and pull cash out within that 5 year, whatever the turn time is for you, that clock gets to start over and over and over and over again. So you're paying almost all interest anyway. So the interest only, if you go there, is going to give you a little bit better cash flow. And if you wanted to accelerate the payoff faster, that's why the all-in-one is so unique. That is an interest-only loan, simple interest calculated daily based on the day's balance and an interest rate every single day for 365 days in a year. It's unique because the all-in-one combines, it's called the all-in-one because it marries two daily drivers of our ordinary lives, banking and mortgage. So you simply just taking all of your deposits from every source and putting them in here and driving that balance down, because interest accrues on the balance every day. The lower that balance is, and for the longer period of a 30-day billing cycle that you can leave those monies in there, the less interest you're going to pay. So I'm a big fan of interest only. For the reasons that I described about the ARM and the inverted yield, the LLPAs, we talked about that earlier, loan level price adjustment for the interest only hit right now makes it counterintuitive. You're not going to find, other than the all-in-one, you're not going to find too many interest onlys that are going to do you the service that you're expecting, right? You would get an interest only because you want to have that better cash flow. That's going to be difficult in the current market, but I'm a fan.
And does the residential side of interest only loans have the ceiling and floor that commercial does?
You mean for rate caps and things?
Uh-huh.
Yeah, you'll have adjustments. Mm-hmm.
Do you recommend for people to look specifically for an interest only loan that has a ceiling or floor, or do you feel like the risk is okay?
No, I don't think you're going to be, let me check myself. I don't think there's going to be a loan product out there in this country anyway that you can secure residentially that won't have some consumer protection.
Okay, perfect.
Yeah, there's
That's
going
good
to
to
be,
know.
there'll be rate caps. There may be some nuance to it, but there'll be caps of, for what the lowest amount that you'll pay versus the highest.
Highest. Yep. Okay, perfect. At what point is the hard pull done?
ASAP. Now
Okay.
okay, this is a good question actually. And it's another one that's, yeah, Stace, you got something?
I was just going to say the second part is, can they get pre-approved without one?
Yes, but I would rather not. And let me, this may be kind of the answer, the behind the scenes answer that I think they're probably asking, but it's not part of the question. So if it's about inquiries, the bad information out there, you guys, is that every time your credit is pulled, you drop 20 points or 5 points or whatever you've seen online. Hold on, I got a call coming in. So that's not true. A hard inquiry is not on its own what's diminishing a credit score. So there's that bad information out there. So let's talk about the repositories: Equifax, TransUnion, Experian. And then we have to talk about the CFPB, which is being dismantled now. So I'm really not sure how this all plays in. But an individual that is having their credit pulled for a multitude of reasons, a mortgage, a new car loan, flat screen TV, they've opened up a credit card at Home Depot, all of these different inquiries, the algorithms within the repositories, the ones and the zeros, that individual is looked at like they're about to become overextended. So in that example, that's when a credit score can take a hit for lots of inquiries. The individual, exclusively for the purpose of mortgage-related finance, has a 45-day window per the CFPB, Consumer Finance Protection Bureau, a 45-day window to have their credit pulled as many times as they want to for shopping, right, for your own checking and due diligence, without an adverse effect to the score. Now, guys, credit scores, kind of like an interest rate, can change daily based on a whole variety of reasons. Your balance, your utilization is a big one, right? The credit card, the high credit limit versus what you owe, 50% and above are really going to mess with a credit score. Below that, there's different tiers that can kind of maximize a credit score. So I wouldn't be afraid of the hard inquiry. It's if you're thinking about it because you think it's going to drop your credit score, the first question I would ask, what's your credit score today? If you're at 760 or above, don't even worry about it. Any impact that it's going to have is not going to have any meaningful effect on your ability to qualify or the interest rate that you could get. Now, if you're right on the line for qualifying, fine, that might be another conversation. But I would also say that for those that don't know, the credit report from the day that we pull it is valid for 120 days before I need to pull another one. And there's some strategy in there. I kind of mentioned this when we were talking about the golden tickets and maximizing. Some of the strategy that I will share with our clients is, if you're in rapid acquisition, if you have 800 credit score, okay, and I know I'm going off topic here, but if you've got a really, really high credit score, but you've just purchased 3 properties in a very small window of time, those algorithms that I was talking about with the repositories, Equifax, TransUnion, Experian, they're seeing that there's this massive amount of debt being loaded to that individual's profile, right? These are mortgages, right? It's not a car or credit card. These are high ticket items. So they're seeing all this, and I've seen 800 credit scores drop below like a 720, where that minimum was that we talked about earlier, temporarily, until those on-time mortgage payments start hitting the report. So going back to my 120 days, that's how long the credit report is valid for. If we have clients, part of the strategy and that we're going to teach and coach them for, as long as the communication is there, I'm going to say, okay, we just closed on 2 deals for Mrs. Clark, and we've got 2 more coming up. And by that time, our credit report's going to be expired before we're going to close on those last 2. I'm going to say, okay, let's pull credit again on day 79 of 120. Now what I've done before those first 2 hit, I have rebought us 120 days in which to finish out whatever we're going to do so that we've maximized that credit score. That would be one of the optimization tools that we would get into. But to your point, I think it's about your score and the inquiry and the hard inquiry. That is bad information. I'll elaborate if you want to talk later.
Perfect. I'm going to run through a few of these because I want to make sure we don't go too far over.
Sure.
Do you do construction loans or construction to perm loans?
Yes, both.
Okay. Being self-employed, a lot of lenders state they need a letter from a CPA to obtain financing, even though they self-prepare their taxes. Does your firm require the same?
Sometimes, and that's probably more about reserves. If your funds to close are coming from a business account, chances are what they've asked for is a letter from your CPA saying that those funds being used will not adversely affect the business. I think it's going to depend on the type of business. I could probably make a case, but I'd need more information.
Perfect. So they should just book a call with you. And I just wanted to confirm, it's a question, but I'm going to phrase it as a statement. You are able to help a Canadian get a loan that has a Canadian and American credit score. Is that correct?
They don't even need a credit score. So one of the products I didn't mention is we have Foreign National. For straight Foreign National, it does not require a credit score. It lets us go to 75% LTV, 30-year fixed. There is a prepay. It's the DSCR product is what that would fall in for Foreign Nationals. And interest rates are probably going to be in the 8s for Foreign Nationals.
Perfect. Does your all-in-one require qualification via W-2, or can you use asset or rental income for qualification?
All of the above.
Perfect. Is there an annual fee for your all-in-one loan?
Yes, the banking features have a $60 annual charge for the banking features of that loan.
Can you use the all-in-one to pay back a private money lender or private money loan?
Hell yeah, that is your money. If there's equity in that property, you have a line of credit. So whatever the balance is, whatever you start with versus a line of credit, the spread between there, you do what you want, when you want, how you want. You're not asking permission. You could do whatever you want with those funds.
Perfect. And last question from Karen. She has an 850 credit score and lenders say it does not make a huge difference for the interest rates. Why is that?
Yeah, 780 and above, more 760 and above for most products is all the same bucket. If all the other qualifying criteria are exactly the same, 760 and above, no difference to the credit score whatsoever. The all-in-one is one of the products. 780 and above is the benchmark. So if let's say everything is identical, 780 and an 850, you're not going to see any difference in the interest rate. It's called a matrix, and that's kind of in that LLPA sector where they've got to come up with benchmarks like 700 to 740 is one, 740, right? They've got to cut it off somewhere, and 760 most often, and then 780 for the all-in-one, and anything above that, no difference.
Perfect. Well, that's all the questions. I just wanted to let everybody know the recording of this webinar is going to be up on the website by the middle of the day tomorrow. So be sure to watch it. This was full of information. And Caeli, thank you so much for shedding all of this wisdom on us. This is the reason you are our premier lending partner, and we are so grateful for your expertise. Thank you again for joining us today.
Thanks, Double S. I appreciate being here. Thanks, everyone.
My pleasure. Thank you.